we're going to see gold move higher. And as far as $4,000 gold goes, I believe we'll see easily 38, maybe 39 this year. We'll definitely see 4,000 by the first or second quarter of next year. To me, when you say, is gold going to 4,000, the answer is it's not if, but when.
I think in the case of silver, what I believe you're going to see here is you're going to see silver break $50. It's a self-fulfilling prophecy. It's going to 50. This is the third attempt at it. And when it breaks it, you'll probably see it run initially 50% beyond that target. And I still don't think silver will be talked about in the Bloombergs and the CNBCs of the world. I don't think silver will become talked about until it gets to an inflation-adjusted new high, which I think is around $150 an ounce.
Gold and silver markets are entering one of their most critical phases in decades, with gold pressing toward fresh record highs and silver preparing for a decisive test of the $50 level. Momentum is building across the entire precious metals sector. Price action has been marked not by sharp corrections, but by powerful spikes upward, followed by sideways consolidation, a pattern that signals underlying strength rather than weakness. Investors who once doubted the staying power of these rallies are beginning to recognize that this isn't a short-lived speculative surge, but the reflection of deep and lasting shifts in global monetary dynamics. GaryWagner, a long-standing analyst in the precious metals markets, has built a reputation for his technical clarity and ability to translate complex price movements into actionable insights. ShawnKhunkhun, CEO and market commentator, brings a sharp perspective on the mining sector and its leverage to rising metals prices. Together, their analysis highlights how gold's consolidation above key levels, combined with silver's resurgence, sets the stage for potentially explosive moves in the months ahead. As global central banks wrestle with inflation and labor market imbalances, the metals continue to assert themselves as the ultimate barometer of financial stress and investor demand for real value. Gold and silver are not just rising, they are rewriting the rules of this market cycle. If you value this kind of analysis, don't forget to like this video, subscribe to the channel, and share your thoughts in the comments below.
When we look at gold, what we've got to realize is that we recently, and when I say recently, the 23rd, or so on Tuesday of this week, we hit the all-time record high. Let me move this out so we can take a look at the high. The high that came in was actually 38.23. That's this small wick right in here. And so the fact that it didn't close at 38 or above doesn't surprise me. What I would like to see, and what I believe we could see, is what we've been seeing recently. We get these big spikes to the upside, near parabolic moves, and then a couple of days of consolidation where it's trading sideways, as you can see right here. And then it will spurt up to the next level. Here's 36.72. And then for 4 days, it trades sideways. What we're not seeing on this entire run is any kind of real correction. And that to me is what is most impressive, is the fact that it runs up and rather than correcting and selling lower, it trades sideways, meaning it's consolidating. And that is a sign of strength. When we look at the action between the 20th of August and current pricing, the longest time that gold is sold off, meaning consecutive days, has been 2 days. That was Wednesday the 17th and Thursday the 18th. And then it springs up to this candle, which is an all-time record close, an all-time record intraday high. So exceedingly strong. I think personally, I wouldn't be surprised if it consolidates and then moves higher. I'm still bullish on gold, unquestionably. Because we are in record territory, the support levels, major support is really low. It's around 3,500. I don't even count it. Then 3,600. And it's only based on these, a couple of days of consolidation with major support, 36.62 to 37. $3,700 to me is major support right now. I'm going to have to go with the Fed.
Yeah.
because buy on rumor, sell on facts seems to be something that still holds true now for the Fed. And the comments that Chairman Powell made on Tuesday are amazing, in which he talked about a dichotomy or a difference between dealing with the problems of inflation, which are still spiked high, but at the same time dealing with a sluggish labor market. And the method to deal with the labor problem is the exact opposite of what he does to deal with inflation. And he was talking about that when he had it wasn't a conference, but he did have a opening speech, and then he was interviewed, in which he said that it's unusual for us to have these two issues at the same time, and both of these issues call for different action by the Fed. So what they're doing is weighing which one seems to be the more prevalent problem and which way to attack it, which means that the Fed is really in a precarious place because it's not a straightforward path, because he's dealing with two things, which is a weakness in the labor market, which would normally mean that you'd want to cut rates and stimulate the economy, and persistent inflation, which means that you would want to maintain or raise. So he's got two scenarios that are happening in the economy at the same time that call for different action by the Fed. And so they're in a quandary. This is the best way I can describe it. Well, I think that as far as gold goes, it seems as though everyone is on the same page.
Yeah.
There's an overwhelming amount of bullish market sentiment, which kind of scares me because that tends to be when a bubble pops, but we have not seen that. I mean, when you think about where gold has gone, meaning from about $3,350 in the middle of August, not that long ago, to where it is now, flirting with 3,800. Of course, this is December futures. It's not parabolic, but it's as near as parabolic as you want to see. I mean, if we compress it, here's a parabolic move right here. We were close to parabolic. And as I said, what we're doing is it's moving parabolic and then consolidating rather than correcting. And that's what is the most impressive aspect to me of what we're seeing in gold, is rather than it correcting after a nice steady gain, what we're seeing is sideways action or consolidation. And that tells you that anytime gold prices get bid lower, there's people there that are scooping it up. So the demand is so great, and whether it's in the ETFs, whether it's in the futures market or physical gold, all of those ways to be involved in gold are running on 8 out of 8 cylinders. They're at full pace right now. We're going to see gold move higher. And as far as $4,000 gold goes, I believe we'll see easily 38, maybe 39 this year. We'll definitely see 4,000 by the first or second quarter of next year. To me, when you say, is gold going to 4,000? The answer is it's not if, but when. This is something unusual because silver was really lagging behind gold. Gold would trade to multiple all-time record new high prices, higher closes, and silver would lag behind. Now silver is playing catch up, and that's what's amazing.
Silver's path toward $50 is no longer speculation. It's becoming a self-fulfilling prophecy. History shows that when this level is finally broken, the move won't stop there. The first leg is likely to overshoot by as much as 50%, pushing silver quickly toward the $75 range before most mainstream outlets even acknowledge what's happening. Proper recognition, however, may not arrive until silver reaches an inflation-adjusted high closer to $150 per ounce. That will be the point of real price discovery, when capital finally rotates out of overvalued equities, bonds, and speculative assets into tangible assets. For those sitting on cash, waiting for the perfect entry, the lesson from 2008 remains clear. Waiting for the crash often means paying more, not less. During the financial crisis, gold was stronger before the collapse than during its middle stages, preserving purchasing power while equities were cut to a fraction of their value. Silver is now on a similar trajectory. Corrections could still follow a surge towards $60 or $75, but prices in a downturn may remain higher than where they stand today. Positioning ahead of the move, rather than chasing it, is the strategy. Let's get back to the interview.
I think in the case of silver, what I believe you're going to see here is you're going to see silver break $50. Okay. It's a self-fulfilling prophecy. It's going to 50. This is the third attempt at it. And when it breaks it, you'll probably see it run initially 50% beyond that target. And I still don't think silver will be talked about in the Bloombergs and the CNBCs of the world. I don't think silver will become talked about until it gets to an inflation adjusted new high, which I think is around $150 an ounce. When we really get price discovery, it'll be after a event where investors rotate away from all of those assets that were just described there: bonds, crypto, traditional equities. We've reached unprecedented valuations in so many asset classes. And what I would just say because I've got friends that have been investing in the space for many, many, many decades, and some of them are sitting on huge amounts of cash waiting for the crash and saying, I'm gonna really step into this gold and silver market after the crash. Now, I've opted to have a different strategy, and the reason for that is, if you go back to the last great crash that we've experienced globally, it was the GFC in 2008. If you waited to buy, let's just focus on gold. If you waited to buy gold during the crash, you had to pay $680 an ounce. You could have bought it pre-crash for half the price. So prior to the crash, it got up to $1,000. So exactly like you said, it was hurt. Now, on a relative basis, it was a lot less hurt than other things. I think in that environment, I think the Dow went from 18,000 points down to 6,000 points. So, your $100 Dow investment was worth $30, where, your gold investment still retained 67% of its purchasing power. So it outperformed traditional assets 2 times. But my simple point is, get allocated now, right? Because so let's say, I think you're going to see $60, $75 silver fairly imminently. And at some point, yes, we will probably get a correction or maybe something even more painful. And in that, everything will pull back. But is there a chance that silver is higher during that crash than it is today? If it runs from here to 75 and then during a crash pulls back to 50, and what are you using to purchase the metal today? You need to rotate out of another asset class. So I don't know. I'll just tell you just a quick story. So in 2020, we had run in silver from sub $12 to $30 from March to August. From $12 to $30 in a matter of months. I knew that was an overheated move. I knew we were going to correct, but I didn't get out of the trade. Out of the fear, I couldn't get back in. And here we are today, 50% higher than that spike high to 30. So you're not going to be able to trade this market. You just need to buy it. You need to sit tight and be right. And whether you pay, $4 an ounce in 1990, or $40 an ounce in 2025, silver is actually cheaper today at $44 than it was at $4 if we factor in all the other inputs and if we factor in what's coming. I want to set the stage at Dolly a little bit. So, when we're talking about silver equities, you've got 10 primary producers. And outside of those 10 primary producers, you have less than 5 companies that are significant non-producers. So Dolly is one of maybe 13 companies that matter in the silver space, that has size, that has grade. We've assembled 5 past producing mines. We've assembled 100,000 hectares of ground in a safe, prolific mining district. And so the results we put out on September 2nd were the richest results the project has ever seen. So we drilled 1,422 grams per ton of pure high-grade silver over 21 meters. And so, why I think this is a special project is because most of the silver we get is a byproduct. This is a primary silver mine. It's high-grade and it's in a safe jurisdiction. What these results really represent, though, is it represents numbers outside of the resource estimate. So right now, the company has, in both the inferred and indicated category, about 64 million ounces of silver, and we have 1 million ounces of gold. So on a silver equivalent basis, it's like 150 million ounces of silver EQ. This drilling represents that growth potential, right? And I think this project is going to demonstrate 100 million ounces of silver, 200 million ounces of silver equivalent. That's my target, and that's where I think we're going. And these results kind of validate that idea of moving towards a 200 million ounce silver district. So it's called the Golden Triangle, right? And then, there's 10 times more silver that's been discovered, right? But it's known as the Golden Triangle. And if we just focus on the gold side of the triangle, in the first 100 years of the triangle, there was 5 million ounces discovered in the first century of the triangle, which dates back to the time of the Klondike gold rush in the 1890s. In the last 3 decades, in the last 30 years, because of indigenous land settlements in terms of certainty that the First Nations group have done their land claim settlements with the BC government, the provincial government, the federal government, because you've got that certainty around access and ownership, because of infrastructure improvements. So we've got roads, power lines, deep water seaports, all that's in place. And because the glaciers that used to cover much of this ground 100 years ago have receded and melted, what you now have in the last 30 years, you've had 150 million ounces of gold outlined in the area. So 5 million ounces in the first 100 years, 150 million ounces discovered in the last 3 decades. That is why I think we're just scratching the surface. Now, what we've done at Dolly Varden is, Newmont is arguably one of the best gold mining companies in the world, 1 or 2 on the planet, right? And their shares have done extremely well, from $30 to over $100 a share. They're operating 2 mines in the district. They're operating the Red Chris mine, which actually was just fast-tracked by our Prime Minister Carney for its copper component. Now, they're also operating the Brucejack mine. And the reason I bring this up is outside of Newmont, Dolly Varden has assembled one of the largest contiguous land packages in the area. So we've positioned I can't compete with Newmont. But what I've done is I've positioned the company in a part of the Golden Triangle that's unexplored, that's not gold rich, that's silver rich. We're outlining with 5 past producing mines and a big mineral inventory, a lot of opportunity to grow high grade pure silver. These mines worked when silver was sub $1. When silver was 85 cents an ounce, the Torbrit mine was Canada's 3rd largest primary silver mine. You go back to the 1919 when the Dolly Varden silver mine was in operation. Canada is part of the Commonwealth. We were part of the British Empire. The Dolly Varden mine was known as the richest silver mine in all of the British Empire. And if you think about the sun not setting on the British Empire back in those days, that's really saying something. There was a lot of steep competition. So we've got this rich history. What I've tried to do by bringing $150 million with some pretty strong investors like Eric Sprott, like institutions like Fidelity, corporations like Hecla Mining, we've brought $150 million. We've done systematic exploration, great science. We've done consolidation. We've bought projects. And now we are positioned, and we did this with a headwind. We did this in a sub $20 environment. And that's why we were able to do it. The best companies are built with depression, right? And we suffered through a depression in the precious metals market. That's the only time you can build real value and wealth for your shareholders. You've got to be out there doing stuff when no one wants to be there. We've now set our stage. And now that the market's come and the generalists are coming, right? We are trading at less than 5% of our in situ value. Right? So there's a tremendous opportunity here when you've got billions of dollars of metal in the ground and you're trading at a fraction of that valuation. There is a tremendous re-rating, whether silver stays here, even if it goes back to $30, or if it goes higher, that headwind turns into a tailwind.
The silver story is shaping up as one of the most asymmetric opportunities of this decade. Unlike crowded trades in equities, bonds, or crypto, silver remains overlooked even as its structural setup strengthens. Supply constraints, underinvestment in exploration, and dwindling above-ground inventories are colliding with a growing recognition that tangible assets are the only defense in a world of inflated paper wealth. When the market wakes up, repricing tends to be violent rather than gradual. Those already positioned benefit, while latecomers are left chasing momentum at much higher levels. This is why discipline and foresight matter. Building exposure before silver captures headlines allows investors to weather volatility and ride the long-term trend. What may appear to be small moves today are actually the foundation of much larger cycles to come. History shows that the best wealth transfers happen quietly, before mainstream acceptance, and silver sits right at that inflection point. If you found this analysis useful, make sure to like this video, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps us bring more deep dive content on the forces shaping global markets.